Hey, this is Harry, your host. So imagine for a moment the absolute silence in a bustling New York boardroom. The phones that usually ring off the hook with lucrative deals from our neighbors to the north have suddenly gone dead. We are witnessing a financial event that was supposed to be impossible, or at the very least highly improbable in the tight-knit economic fabric of North America. Canada, our polite and perennial partner, has just done something that has sent a shockwave through the canyons of Wall Street, leaving bankers and policy analysts scrambling for answers. They haven't just politely declined a dinner invitation. They have effectively locked the doors and changed the locks. We are talking about a multi-billion-dollar bond shock that is freezing out U.S. banks in a way we haven't seen in over a decade. This isn't just about money. It is a loud, undeniable geopolitical scream. What happens when America's oldest ally decides that Wall Street is no longer the center of the financial universe? You are about to find out, because the rules of the game have just changed, and the score is being settled in billions. Let's get right into the heart of this unprecedented shift. Ontario and Alberta, the two economic engines of Canada, have issued massive foreign bonds that completely sideline U.S. banks. To put this in perspective, Ontario recently issued a $2 billion bond deal. In the past, a deal of this magnitude would have American banks fighting tooth and nail for a piece of the action. It is standard operating procedure. But this time, the list of underwriters was missing the usual heavy hitters from Manhattan. Instead, the deal was led by Barclays and a consortium of Canadian banks. This marks the first U.S. free bond issuance from the province since 2011. If you think this is just a clerical error or a minor preference for local vendors, you need to look closer at the timing and the context. This is a calculated strategic maneuver designed to hit where it hurts the most, the balance sheet. Why is this happening now? The answer lies in the increasingly tense atmosphere surrounding trade and tariffs. We are seeing the fallout of aggressive U.S. trade policies that have squeezed Canada's steel and auto sectors. When you push a country's primary industries into a corner, they don't just sit there. They find a new way out. By pivoting away from Wall Street, Canada is sending a message that is clearer than any press release or diplomatic cable. They are saying that if their goods are going to be taxed and their industries threatened by American protectionism, then American banks do not deserve to profit from Canadian debt. It is a financial pivot that raises a terrifying question for those relying on the status quo. Is this the beginning of a new financial era in North America where New York is no longer the default option? The implications of this freeze-out go far beyond the immediate loss of fees for American bankers. It signals a fracturing of the integrated North American economy. For decades, the flow of capital between Canada and the U.S. has been as fluid as the flow of the Niagara River. But now we are seeing dams being built. Ontario's decision to turn to European and domestic banks is a signal that they are diversifying their risk. They are actively choosing to decouple their financial future from the whims of Washington and the volatility of American trade policy. This is a diversification strategy that we usually see in emerging markets, not between the world's largest trading partners. It suggests a level of distrust and defensive posturing that should worry anyone invested in the stability of the North American markets. As we dig deeper into this story, we have to look at the mechanics of the deal itself. A Yankee bond is a bond issued by a foreign entity, such as the formulation of the Ontario government, but traded in the United States and denominated in U.S. dollars. Typically, U.S. banks underwrite these to ensure they sell. By cutting them out, Ontario is proving that they don't need Wall Street's blessing to raise capital. They are proving that global markets, specifically London and Frankfurt, are more than willing to step in and fill the void. This success emboldens not just Ontario, but other provinces and potentially other nations to reconsider their reliance on American financial infrastructure. If Canada can freeze out U.S. banks without the sky falling, who is next? This is the hook that has everyone watching. The precedent has been set, and the ice is getting thicker. I want to speak directly to what is driving this wedge between two historic allies. It is impossible to discuss this financial freeze out without addressing the elephant in the room, the tariffs. We are watching a high-stakes game of tit for tat that has escalated from trade rhetoric into a full-blown jolting of the continent's financial wiring. This isn't just business. It is political warfare played out on ledgers. When the U.S. administration moved to impose tariffs on steel, aluminum, and automotive components, the assumption might have been that Canada would simply absorb the blow. But that calculation was wrong. In June 2025, Ontario fired back, not with a press conference, but with a $2 billion Yankee bond that pointedly excluded every single U.S. bank. This was the financial equivalent of a cold shoulder, and it was absolutely intentional. Let's look at the leadership behind this decision. The administration in Ontario, led by Doug Ford, has made it clear that they are not going to take these economic hits lying down. They had already started deprioritizing U.S. firms in public contracts. A move that was the first warning shot, but targeting the money pipeline that is an escalation that is going for the jugular by handing the deal to Barclays, CIBC, Scotiabank, and others. They ensured that the fees and the prestige of the deal went anywhere but New York. This was Ontario's answer to the tariffs on tech and steel. It is a way of saying, if you tax our exports, we will boycott your services. It is a sophisticated form of economic resistance that hits the U.S. service economy, specifically the banking sector, in retaliation for hits to Canada's manufacturing sector. You have to understand the sheer scale of the money we are talking about here to realize the gravity of the situation. Ontario is a massive borrower on the global stage. The province expects to borrow somewhere in the neighborhood of $60 billion this year alone. Historically, a significant portion of that, nearly a third, comes from foreign markets, with Wall Street acting as the primary gatekeeper. When you suddenly divert that river of capital, you are talking about billions of dollars bypassing American institutions. That is a lot of revenue lost, but more importantly, it is a lot of leverage lost. When U.S. banks hold Canadian debt, they have a stake in the game and a voice at the table. When they are excluded, that influence evaporates. The connection to the automotive sector here is critical. Ontario is not just a random province. It is the Detroit of the North. It is home to massive assembly plants for Ford, General Motors, and Honda. The economy there lives and dies by the auto industry. So when the provincial government flexes its financial muscle, the automotive sector is watching closely. By sidelining U.S. banks, Ontario is signaling to these automakers and to the U.S. government that it is done playing ball on a field where the rules are constantly being rigged against them. It is a protective measure for their local industries. They are demonstrating that they have options and that they can sustain their financial needs without bowing to pressure from their southern neighbor. This is a geopolitical maneuver as much as a fiscal one. We are seeing a distinct shift in direction. Ontario is steering its financial partnerships away from New York and looking toward London and Frankfurt. This pivot is happening quietly but decisively. It is a strategic realignment. By strengthening ties with European financial centers, Canada is building a buffer against American unpredictability. It is a hedge against the volatility of U.S. trade policy. If Washington wants to use trade tariffs as a weapon, Canada is showing that it can use capital markets as a shield. The message is clear. We will find partners who respect our economy. And right now, those partners are across the Atlantic, not across the border. Now, if you thought this was just an Ontario story, you need to look west. The province of Alberta is hitting the throttle on this strategy as well. And in some ways, their pivot is even more significant given their resource-heavy economy. Alberta isn't riding solo in this rebellion against Wall Street dominance. Back in March, they made their own power move that went largely under the radar until you connected the dots. They floated a bond worth whacks $1.25 billion TAL. And just like Ontario, they did it without the help of Bank of America or any other major U.S. institution. This broke a 6-year streak of reliance on American banks. Instead, they handed the keys to Barclays, RBC, and TD. It is a pattern that is becoming impossible to ignore. Official statements from Alberta might claim that U.S. banks weren't explicitly banned and that this was just a business decision based on competitive rates. But let's be honest with each other here. In the world of high finance, there are no coincidences of this magnitude. The signal was loud and clear. When you deliberately choose European and Canadian underwriters for a massive euro-denominated bond, you are making a statement about where you see your future alliances. Alberta is effectively saying that they are diversifying their Rolodex. They are cultivating relationships with European bankers who are less likely to be strong-armed by American political whims. It is a smart, albeit aggressive, insurance policy against total reliance on a single partner who has turned hostile. This pivot goes beyond just paper bonds. It is bleeding into the physical world of exports and logistics. Alberta is steering its oil exports into new territory. Quite literally, we are seeing tanker routes being recharted. The traditional flow of energy south to the U.S. is being reconsidered as new pipelines and transport corridors look toward Asia and the Gulf of Mexico for export to global markets. And guess who is backing the financing for these new ventures? It is European insurers and bankers. The money following the oil is no longer exclusively American. Pension fund managers and institutional investors from Europe are hopping on this trend, sensing an opportunity to displace Wall Street in a stable, resource-rich market. The boardrooms of Frankfurt are becoming just as familiar to Canadian executives as the meeting rooms of Washington used to be. We are seeing a shift in where the complex financial machinery, currency swaps, hedging strategies, and derivatives is being operated. It is moving from Manhattan to Mayfair. This matters because whoever holds the debt and manages the risk also holds the influence. If European banks become the primary lenders and insurers for Alberta's energy sector, they will have a say in how that sector develops. This could introduce new dynamics regarding environmental standards and operational transparency that align more with EU regulations than US preferences. For the average trucking operator or logistics company in Edmonton, this might seem high level, but it hits the ground eventually. This pivot means reevaluating capital sources. If you are a heavy hauler in the energy sector, your next financing deal for a fleet of trucks might not originate from a lender in Philadelphia or Houston. It might come via a credit facility backed by a bank in Frankfurt. Supply contracts and insurance backing are all being reviewed through this new lens. The financial ecosystem of Western Canada is undergoing a root and branch transformation. They are untethering themselves from the U.S. financial grid to ensure that if the border tightens, their economy doesn't suffocate. Let's bring this down from the high towers of finance to the factory floors and the supply chains that keep our economy moving. The tariffs and the bond freeze-out haven't just redrawn Canada's debt map. They are fundamentally rewriting who wins government contracts and who supplies the nuts and bolts of industry. We are seeing a new era of buying Canadian that is more aggressive than anything we have seen in decades. Ontario's new procurement rules are explicitly designed to favor Canadian and allied vendors over US ones. This is the direct backlash to America First. It is Canada first, and it is closing the door on American businesses that used to take access to the Canadian market for granted. If you are a software firm in Seattle or a steel supplier in Pittsburgh, the writing is on the wall. Good luck cracking those bids. Unless there is absolutely no local option available, you are going to the bottom of the pile. We are already seeing concrete examples of this. Take, for instance, a recent hospital contract where the administration chose a Swedish software provider over a U.S. competitor. The official reasons cited were currency risk and cost efficiency, but the subtext is undeniable. In a climate of trade war, relying on U.S. vendors is seen as a liability. Why tie your critical infrastructure to a country that is threatening your economy? It is a risk management decision that is shutting American companies out of millions in revenue. This isn't a one-off event. It is a systemic shift. Multiply that one hospital contract across thousands of public sector bids from municipal broadband systems to provincial infrastructure projects, and you have a massive economic displacement. The bolts in your car's frame, the steel in the bridges, the servers in the government data centers. The sourcing for all of these is changing. For the automotive giants operating in Ontario, this adds a layer of complexity to an already strained system. With Canadian steel climbing to the top of the supplier list and U.S. inputs getting pushed down, procurement managers are having to scramble. They are recalibrating supply chains that have been integrated for 50 years. The impact on the factory floor is real. Automakers like Ford, GM, and Honda, who have massive footprints in Ontario, are caught in the crossfire. They are watching as the province prioritizes local supply chains. This means shifts in procurement patterns inside the factories. If the province is financing its debt through Europe and prioritizing local steel, the pressure is on the automakers to align with those priorities to maintain favorable relations with the government. Supply chains were already fragile after the global disruptions of the last few years. This political standoff adds a layer of deliberate friction. It is a recalibration of the North American automotive machine, and it is grinding gears as it shifts. Even British Columbia, which has traditionally remained partially aligned with U.S. financial firms due to its coastal trade ties, is getting swept up in the broader trend. The North American financial gearbox is grinding and Canada is shifting into a new lane. This is not just about punishing the U.S., it is about survival and autonomy. By building a supply chain that is less dependent on American inputs, Canada is trying to tariff-proof its economy. But for the U.S. businesses that rely on the northern market, this is a disaster in slow motion. They are losing customers not because their product is bad, but because their passport is currently a liability in the eyes of Canadian procurement officers. As we approach the final analysis of this situation, we have to look at the invisible architecture that holds the global economy together, the U.S. dollar. Behind the scenes, beyond the bond issuances and the steel contracts, Canada's financial architecture is quietly shedding its reliance on the greenback. We are seeing subtle cracks in the dollar's armor as Ontario and Alberta shift their gears. These are quiet fractures in the North American dollar-based system, but they are beginning to hum beneath the surface. In trading hubs like Vancouver, late-night commodity traders are reporting something disturbing: liquidity snags in accessing U.S. dollars. We are hearing echoes of the 1998 Asian financial crisis, not in terms of panic, but in terms of friction. It isn't a full-blown crisis yet, but the warning lights are blinking on the dashboard. Canadian financial institutions are starting to model risk differently. They are looking less at the Federal Reserve's playbook and more at the European Central Bank's yield curve. This is a profound psychological and technical shift. It is more than just a spreadsheet tweak. It is a change in who sets the tone for capital strategy. When your neighbor stops looking to you for leadership and starts looking across the ocean, you know the relationship has fundamentally changed. While cross-border capital flows remain robust, we are still talking about $1 trillion of Canadian money parked in the U.S. The sentiment has shifted. Institutions are installing just-in-case hedges. They are staying exposed but bracing for turbulence. We are seeing this volatility hit the ground in real time. In places like Thunder Bay, local businesses are feeling the whip crack of global trade wars. A solar panel startup might see a boom because tariffs hit Chinese imports only to get burned by delays in components caused by these new trade barriers. It is a reminder that in today's supply chain jungle, even local wins are tied to global bottlenecks. But the biggest ripple effect is in the auto industry, where financing decisions are steering the future of car production. When provincial borrowing moves to Frankfurt, it reorders who gets a seat at the investment table. European financiers are driven by different mandates, particularly regarding ESG, environmental, social, and governance criteria. This brings us to a potential conflict. European lenders may shy away from funding carbon-heavy initiatives, which creates a paradox for oil-aligned provinces like Alberta. Automakers may soon face a new reality where their financia is evaluating their emissions more than their profit margins. It is a reshuffle deck, and the U.S. is holding fewer cards than before. So what is the final verdict? We have to call this what it is: a financial breakup with industrial fallout. Canada didn't just decide to skip one dinner at Wall Street's table. They are building their own dining room. The headlines might be about bonds, but the real story is the decoupling of key systems, logistics, procurement, and capital, one contract at a time. This isn't a flash in the pan. This is a slow-burning shift that could reshape how North American industries operate for a generation. We are witnessing the prototype of how countries respond when economic partnerships grow tense. They don't just argue, they decouple. This raises the ultimate question for all of us watching. Are we witnessing the early stages of a broader economic divorce between Canada and the US? Could this open the door for China or the EU to gain permanent leverage in our backyard? The gears are turning, the bonds are sold, and the money has moved. The only question left is how Wall Street and Washington will respond to being left out in